Welcome back, everyone. I wanted to check in a little bit and give some updated thoughts on the market. If I sound terrible or different, sorry, I'm just getting my voice back after a number of days where it disappeared. But anyway, I'm titling this video, "This market is very hard," and anyone in it can see that, and so I'm just going to go into why I think that is and what am I seeing out there. Now, if we rewound to the second half of 2020 and into 2021, the market was not hard. It was easy. Mostly everything was going up. Everyone was making money in things where they should be making money and they shouldn't be making money. And everything was going well. Now we're not. Now things have stumbled back to a more reasonable level of reality. Some things have been hit hard, other things have been hit harder. It has not been a fun market recently. Now the good thing is, I think some of this has led to the return of there being some value in the market and not I'm not talking about what's performing or what's going to perform. I'm talking about the prices. The prices, I haven't seen this kind of widespread reasonable to favorable pricing in stocks in a while. Now, this type of thing comes about because people are skeptical about a number of things, but realistically, there's a lot of regions where things look inexpensive. And, when I'm looking at the expected returns of the average stock in my portfolio, even though or because it's been hit, I think the returns are higher than I've seen in a long time in terms of what I am expecting going forward. Now, I think this is because of a lot of pessimism. There's a lot of people that are either afraid of the inflation. I don't know, maybe you've heard there's some inflation going on around. I certainly did not think it would be lasting this long, but I do see a number of points where it's breaking, a number of points where it's continuing stronger also. But the point is the market is either fearing the pressures of that or the pressures of what the central banks are looking like they're going to do to fight that, or a combination of both. And realistically, that has caused a lot of enthusiasm to be priced out of the market. And you see that with a lot of prices falling. And, we're between a rock and a hard place, but that doesn't mean that necessarily we're going to be crushed by both. It's not an easy situation, but the market sees that. Now, some of my frustration with this market is that, I look around and it seems like people are fearing both sides. They're fearing, oh, there's out of control inflation, and it's just going to keep being more and more out of control until the Fed takes interest rates to the moon to crush everything. But that's not what I'm seeing. I'm seeing, as I kind of said before, there's inflation and then there's rising inflation. And the inflation itself has been stronger than many, including myself, have anticipated. But that doesn't mean that it is rising at an out of control pace. There's signs, look at the break evens, look at the used car prices. I'll get to more of this later. Even energy prices, where you look and the flashy big picture numbers that you see from the year over year increases, a lot of those numbers are not really sustainable. That you're seeing a slowing of the rate of inflation. Now, some people will still say, yeah, but there's still inflation. And yes, I mean, their money in value goes down. I mean, that's, how it works. There's inflation. The question is, if we worked through the pain that we got from the excessive stimulus hitting the economy and the inflation into a broken supply chain, if we work through that, will the inflation continue at a crazy pace that will need the Fed to take interest rates way, way higher? And I don't think so. I think that supply chains are getting less bad. I think that the cure for high prices is high prices, and you're seeing some of that. You're seeing different pockets of different demand destruction. You're seeing things are cooling, and we're working on being less broken. So as long as there's time enough to realize that things are getting less bad, I think that there's room for a recovery. Now, this means that essentially my opinion on rate hikes is that we've probably already priced in at least what we need, maybe more. And, if the Fed will be data dependent, which they say every freaking meeting, then they should be able to read the data as it comes in and stop the brakes when they need to, or maybe just a little bit after they need to. Because don't get me wrong, if I believe that there was runaway inflation and that the only way to beat the inflation were to put the interest rates higher, I'd say go for it. But that's not what I believe. Because what I do believe is that in markets there are a lot of aspects that counteract each other. So I feel kind of strongly that we'll land somewhere in the middle. Now, does that mean a soft landing, as everyone wants to say? Not necessarily. It just means not the hardest landing, that if you were to just look in a straight line and say, oh my God, this is terrible, that's probably not going to happen, because it will, things will happen along the way that will slow the descent, slow the ascent, and kind of bounce around the middle more than blow up in one direction, because everyone is always looking at things completely blowing up, the chain reaction effect. And that's realistically not what happens, because they start blowing up and that causes something else to break, and then that thing kind of fixes the original. I mean, I'm getting way into the abstract here, but the cure for high prices is high prices, the cure for low prices is low prices. If the high inflation is destroying the economy, well, then the destroyed economy will destroy inflation. It's Ouroboros, I think it's called. Things feed off of each other. Now, I just wanted to talk about a few other pieces that I'm seeing that make me say that I don't see this as out of control inflation. And I know what people are going to say, but food, but rent, but energy, or just but out of macro. There's just more pieces to the equation. And I mean, if you look at the last print, the big surge was fares for flights. And I mean, the interesting thing about that is, all these companies, they tack on a whole bunch of debt because they're trying to survive and they can't operate at normal levels, tack on debt, issue equity, whatever. Then they come back and, okay, people want to fly again. And but now there's also the surge in input costs because there's higher fuel prices and higher, so higher costs and higher costs of debt. And you look at this and they're like, okay, so in order for them to make any money, they need prices to be higher. Okay, there's your inflation. Okay, now the Fed needs to fight this inflation. Okay, so how are they going to fight this inflation? Well, they're going to raise interest rates. Well, why are they going to do that? What will that do? Well, it will lessen demand. And well, what else will it do? Oh, well, it might raise their cost of debt, so it might actually make it harder for them, and they might have to raise prices even more. But let's ignore that. Well, what else will the higher interest rates do? Well, it will lower demand, so there's going to be less demand. So what you're saying is they won't be able to fill the planes, and so each passenger will have to pay even more for them to get anywhere. So the price will go even higher, and it's just like, I understand the reasoning for raising rates, but this is just a situation where it's like a man with a hammer sees nails everywhere. And it's really, I don't know how I got on this tangent, but we really need to think about what we're doing more than just act. But back from this weird tangent, some of the pieces of inflation not particularly being out of control. You look at used vehicle prices. Well, they've rolled over and they're down month over month over month. And I don't know if they peaked in January or February or something, but they're down. And if you look at how year over year rates work, if prices were flat from here, and by the way, they're falling, then the year over year rate decreases and decreases and decreases until it becomes negative or deflation. Now that's just one component, I know. But the chip shortage that was holding up supply chains, and I know that there's chip CEOs that are saying, well, it's not fully solved yet. That's true, but there's also their clients that are saying, well, it's getting better, and so less supply chain disruption. So that's also deflation almost, in terms of you get more goods for similar work. As inventory builds have started happening in different places, not everywhere, of course, but some places have reversed course there. You look at availability and prices for many transports, and they are falling, not surging out of control, not flat at a very high level, falling. Okay, again, it doesn't necessarily seem like things are going crazy out of control and we need to break the economy, but okay. But there are things that are still kind of very strong. You look at the Russia-Ukraine commodities, but even those, they've flattened, and while they've flattened, copper has struggled. Copper has been kind of sliding a bit recently. If there's inflation, it would be copper going up slowly and not flat or going down. I mean, maybe it'll catch up. It may. You don't know what's going to happen next, but for the time being, it doesn't look out of control. And the commodities across the board have kind of off their peaks, and there's been they a year ago or a year and a half ago, they were not at a place that was incentivizing supply. So you had the shortage, you had the future shortage being inevitable, and you had the narrative of no one's investing. Because no one was investing. Because the price was too low. But the price is not too low anymore. And so there's incremental small investments here and there. Plus, you also have the significant amount of base effects. And if you don't know what that means, it's essentially looking at year over year numbers as opposed to absolute prices. And essentially, In Q2, which is kind of what I was looking at last time, in Q2, there was a big surge last year, which means that if you got the equivalent surge this year, it would be flat. If you got flat this year, it would be down. If you got down this year, it would be down a lot. And so you have that period now, and then you have another one of those periods in the third quarter of this year. So keeping high inflation numbers, like headline numbers that's everyone's concerned about, is difficult. Is it possible? Sure. And have we beat what I would have thought things would happen? Yes, multiple times. But going forward, that becomes more challenging at a time where you have a lot of components that are not flat but going down. But what does all this mean for stocks? Well, that's a good question, because in the short term, the answer is very, very questionable, because the pace of some of this puke in the broader markets, the pace of the sell-off has been, in my opinion, has gotten a bit far ahead. And that's not even to say that it'll continue, because I think everyone has kind of lumped in all their fears into what could happen into the market, and just, this stock, I don't really love it, and I don't know what's going on, and everything else is falling, so buy. But, stocks, again, have gotten rather inexpensive, kind of broadly, and you look at historical valuations that those types of companies will receive. And, if you are able to look out 1, 2, 3 years from here and think, okay, well, what will this company be earning? What should that earnings be worth? I think this is a decent spot to start thinking about, or, if you're not already, to be thinking about buying. But if we're talking about what's going to happen next week and next month, I don't know. Now, this leads me to one very underrated aspect in the equation, and that is time. I think that if the market could just stop and go sideways and kind of consider where it is, if you will, I think many people would be fine buying and owning and holding, because there's the fears here, and some of them will come to pass and some of them won't. And we kind of, if we get to see what happens, it's kind of like unlikely to be that bad. You see a few quarters, the companies will either execute or they won't. Inflation will get back under control or it won't. Things will be that bad or they won't. And, so just seeing how things play out, and breaking the correlation one, sell every single stock, I think there's more good things that will come out of that than surprisingly bad things. But, in a short-term, fear-driven or uncertainty-driven sell-off, it's really hard to understand what's happening in the week, in the last week to next week. It's all now, it's all moving fast, and you got to act before whatever. And that's kind of what we're seeing. And slowing down and giving the market time to think about how this actually plays out, and to see where, are things getting worse? Are things getting better? And to kind of breathe And that's kind of one thing that I think the market hasn't got a lot of recently and would really benefit from. I think a lot of people, a lot of portfolios would benefit from the market kind of slowing down. Now, the general direction that I've been moving with my portfolio is I've been adding beta, or that's how I think about it at least, in terms of adding things that will move more than the market. And that's where I've been putting the incremental dollar in my portfolio. And the type of returns I've been targeting, sorry, are more than 100% move in the stock price over the next 12 to 18 months. And on the top end of what I think is available, it's something like that in this market. Now, can it take longer? Oh, absolutely. But a lot of the companies, I think that when things normalize, that's the type of return I think they get, and I think they're fine along the way. And that's what I've been looking for, 100, maybe 150% from here. Just thinking about, okay, in 2 years, what's this going to earn? And when it earns that, what's a reasonable valuation for it? Some I'll be wrong. Some I won't. Probably. I mean, I could be wrong on everything. It's possible. But yeah, so what's my risk? What's my downside? Like what could happen in the meantime? And if it's a solid, profitable company that is growing earnings and will be making a lot more, I think, in 1-2 years. I mean, and it's trading at, I don't know, 3-4 times that. That's the type of thing that probably when you get there, it'll be worth double the current price, and there you go. I mean, it's that simple. But generally, I've found that these things are kind of more in the higher beta sectors of the market, and that's where I've been putting dollars. Now, I did this little exercise. It's maybe a few days stale, but basically serves a purpose. I looked through some of my portfolio, just a bunch of names on one of my watch lists, and just took a bunch and looked through. What are their price to earnings ratio? Are they expensive? Is there better opportunities available? And really, I mean, are they expensive? The answer was, I mean, a lot of them is like no, like really no. They're trading at 9, 12, 5.5, 6, 6, 5.5, 5, 3.5, 8 times earnings. And most of them are growing earnings from there. And, if you're looking at what the expected return on something like that is, some of them are obviously growing faster than others, and some of them are more depressed than others or more elevated. But, I mean, if your portfolio has cheap stocks, I'm inclined to think that it does decently over the long term, and that's where I'm at now. And so I've had a few people kind of ask, what you doing? Are you selling anything to go do something else or raise cash or whatever? What? I mean, there's things I could sell to consolidate the portfolio, but these things pay a 4 or 5% dividend in cases, or are growing, or are very depressed earnings, and I'm just kind of thinking, okay, the move is to wait it out. I mean, the stocks aren't expensive. I mean, at least these for me. And then I also look at the quality side of my portfolio. Some of the names that it's like buy and hold forever, and they're down a bit. But they're good companies. I mean, what should I do? Should I sell them to try and get more aggressive elsewhere? I mean, that's possible, but you kind of want to have some quality in your portfolio and you look at how the companies have grown, either their book value or earnings or distributions or share price or whatever, and they've kept going, and they've held up mostly fine, but they'll go up a bit more or down some with the market, and over the long term, you just kind of punch in, like, I don't know, they've all grown more than this, but you punch in 15% into a calculator and compound that a few times, and, it's good returns. So kind of what you need to do is just hold through and just realize that in 5 years, 6 years, these companies are going to be worth twice as much. Will they be priced twice as much? No. Could they be worth 1.5 times as much, 1 times as much, 3 times as much? I don't know, but historically they're going to be worth a lot more. Now, what the share price is going to be, I don't know, but trying to fight the market or time the market, I don't know, it doesn't seem effective. And then I look at capital decisions, the simplest capital decisions available to companies. And there's a segment of the portfolio trading at, I don't know, 65% of book or NAV, 60, 75, 40% of NAV. And you look at, well, let's say the company just spends some of their capital and buys back shares at those prices, and like, what is the yield on that capital? Was that like 50% on some, 100%? I mean, this is not like trying to discover a new type of energy that's going to yield you a return of 100%. This is just, your profits that you have because you're making money and what you can get with them. And, if your shares are trading at 50 cents and you spend $1 on your shares, that's, oh my God, I did this math in a complicated way, but, you're doubling your money. And that's just what what's available simply to the companies. And well, you're holding this, and you get a yield from the dividend, and you get some like high expected returns on the buybacks, and that's great. I mean, what you gonna do? And so I look at the market, I look at my portfolio, and I'm pretty happy with where I think the expected returns should be on most of the names. And I essentially think that my whole portfolio is some variation of buyable here. I mean, you only have so much money, but I think that all of if I didn't think that my stocks are undervalued here, I mean, I'd move the money to something else. I mean, but I do, so that's why I still hold all the names of my portfolio. And generally I'm happy buying all the stocks, and if the companies are buying back the stocks because it's more effective for them to do that, then give me the money and for me to allocate to the best part of my portfolio. And if they can earn good enough returns with the buyback instead of dividends, then that's fine. I mean, but if they give me the dividends, I'm happy that way too. It's what can you say? I mean, if you put the money in the right stocks over time, it should work. Of course, there's more to having the right portfolio and having a good portfolio than buying things that are trading at low earnings multiples. There's different qualities of earnings. There's different, macro environments that are going to hurt and help different sectors. There's different growth rates, all that stuff. But overall, it's just recently it's just the market being the market and kind of punishing everything. I mean, I look at my portfolio and I'm down something like 2 times what my net worth was in 2019, and that's not fun. And I know there's other people that have had a tougher time than myself, and overall I'm things haven't been as bad as they could be. But I think my portfolio when I kind of assess it, I think I'm discounting interest rates of 5% or higher for some period of time. And I think that's way more than what's needed. And I think that's too much. And, discounting that or some significant economic damage that I think will probably be stopped along or before it happens. And, that's kind of where we're at. Multiples have come in, and, the most exotic parts of the market where the multiple is the hardest to determine, they've kind of been hit the hardest. And the money, the stuff that's losing money has been the hardest to hold because, A, the terminal rate has increased in people's minds at least, and B, there's less free capital flowing around to fund cash burn until the growth or the profits materialize. But lots, if not everything, has just been kind of tossed in with it recently, and that's the part that's unsustainable. I mean, companies that burn plenty of money can essentially go to zero, but companies that earn money, I mean, won't. So what are some of the things I am watching for in markets? I'm watching for a stabilization, kind of, stop falling, kind of put in some sideways action. Let's see. I'm looking for a rally in the long bonds particularly. I think that I'm kind of in the Jeffrey Gundlach school right now, where I think that the long bond should be probably closer to, should head towards 2.5 rather than the 3. I'm wondering if that's just started, the rally in the long bonds. It may have started last week along with some interesting, the break-evens rolled over, which is interesting. They kind of looked like they were consolidating, and it kind of fell for no apparent reason aside from potentially inflation rolling over. So, which is another point that I'm watching for. Yes, we did get a lower print, unsurprisingly, and if it keeps going lower, and if we keep seeing the inputs, one by one, the generals fall off, if they fall off, if they stop, that's probably bullish because we finally realize, okay, it's not out of control. We might be back in control. Let's go worry about something else, that type of thing. And another thing that has been kind of, I don't want to get too much into this, but oil. I'm looking for the response to this price. I put sequential oil builds, but that's not really what I'm looking for. I'm looking for the supply response showing that this price is high enough to produce more than before, and that we can get the growth back in the supply, because we need that to balance things out. And it has been lackluster so far. Now, with just a few closing thoughts to leave you with, broadly in the market, valuation seem reasonable to inexpensive, especially compared with the last number of years. Next, if the Fed remains data dependent, they will act accordingly as they see what happens, and which means that they'll pivot when needed or slightly after. The market is a complex system. There's internal and external breakers in the system. And last, Buffett has been deploying a lot of cash, and frankly, I can see why. There's value out there and there's fear, and that's when you deploy cash for looking for the long term. it's a tough environment out there, no doubt. But I think the pace of the fall and the amount of gloom out there is excessive. Anyway, that is basically all I wanted to say for today, aside from the usual that nothing in this video is investment advice, obviously, because, you know, I suck. But anyway, wishing everyone all the best, and until next time, good luck out there.